Welcome to The Dealist, your insider's guide to navigating the complex world of M&A. My name is Catherine Ford, and in today's episode, we're going to find out all about what M&A advisors really do in the transaction. Joining me are Arash, Farin, CEO, and Jay Liebowitz, Managing Director of Centerstone Capital. Let's jump straight to the conversation. Thank you very much to both Arash and Jay for being here with me today. Arash, could I ask you just to introduce your business to our listeners quickly?
Yeah. Hi, Catherine. Nice to be here. And Darren, thank you for the opportunity. So Centerstone Capital is an investment bank, middle market focused. Our transactions are usually between 100 million to a couple billion. We have 10 employees and we're located in LA and New York, primarily doing mergers and acquisitions and capital raises.
Super. Thank you so much for those words of introduction. Now, the podcast is going to talk about what advisors really do during an M&A transaction. And I'd like to start with a conversation around where you feel the role of advisors is when it comes to assessing risk versus opportunity in a transaction. Arash, can I have a few words from you on that topic?
Yeah, I think obviously tradition in our business, the greater the opportunity, there's also greater the risk. And I think that we try to contextualize that for investors to reduce the amount of risk that's perceived, but maximize the opportunity out there. And I think we spend a lot of time with our clients trying to get them to think outside the box, get them to unlock opportunities in their business from a revenue generation standpoint and cost-cutting standpoint and profitability in order to maximize what that could be within the realm of reason. And then when we're speaking to investors, help them really assess the risk, put ourselves in their shoes, not be too biased on our side, and help them really think through all these different risk factors and hopefully minimize the perception of that risk every step of the way.
And how much do you get directly involved? You spoke about the need to not be biased when you're presenting both the risk and the opportunity. How much of a challenge is that?
I think it's a constant challenge. There are different kinds of investors out there. There are those who are a little bit more forgiving. There are those who are assessing every cell of the models that we build and so on. So I think, first of all, to understand the perception and the risk appetite of that investor, and then to, again, put yourself in their shoes, think as if you're on their investment committee and, try to help them think through these issues. But it is a constant, it is just as important as anything else we do, which is to discuss all these different facets of a transaction and then to individualize it for every single firm because no two firms think alike.
Jay, can I bring you into the conversation? One thing that we've discovered on the podcast is that obviously the amount of information that is available to deal makers in a due diligence process has grown significantly over the last few years. Do you feel that helps or actually hinders at some points this analysis of where the risk and where the opportunity is? Is too much information sometimes a little bit too difficult to process?
Yeah, I would think that a lot of times it is difficult to process for folks. You're 100% right. But at the same token, the quality of work that potential investors do has increased exponentially, and obviously they have the tools, to do that with respect to their own processes, with AI, things of that nature. So they've been able to distill it down into a more viable process for themselves. But I think all of this speaks to the need on the part of potential sellers of a business of, a high degree of preparation. And so that's really part and parcel of what we do as investment bankers, is that we spend weeks, if not months in advance of going out to a process, explaining to working with our clients, helping them gather the data, cleanse it, understand how it'll be perceived, and even taking in that next step, providing them question lists and preparation materials of that nature to ensure that they're never surprised by the depth of diligence that's involved in the business.
You got us really nicely onto the topic of diligence. And obviously diligence covers a really broad spectrum of different types of information that people might want to look at. I'm thinking about commercial, operational, financial diligence. Arash, talk to me about, first of all, what you cover in each of those areas. So maybe let's start with the commercial side, then look at operational, then financial. But then also tell me a little bit about where you feel you spend the majority of your time and where clients want you to spend the majority of their time and possibly why. Oh, that's a long, complicated question I've presented you there. So start with the commercial diligence, what you look at in that space.
Yeah, I think that the commercial diligence is really focused on helping the the client get their story out and, what is the reason for their existence? How are they disruptive in the industry? What are the any kind of tailwinds or headwinds in the industry? And how are they unique and differentiate in what they do? So we spend quite a bit of time on the commercial side thinking through these topics. And I think especially in the consumer sector, differentiation is really key. Whether you're apparel or jewelry or location-based entertainment or footwear or any other subsectors of consumer, that differentiation is really critical. And it's not just the idea of the differentiation, but the execution. So once you identify your narrative and what makes you unique, it's also how does the company execute against that plan?
Okay. Talk to me about operational due diligence. What do I have to sort of envisage when you talk about that?
I mean, that includes many things. Operationally, obviously, I think financially is really where a lot of the rubber meets the road. Looking at if you're an e-commerce company, there are a lot of KPIs you can look at, from the lifetime revenue to the customer acquisition cost to the ratio of lifetime value to customer acquisition cost, the repeat rate, conversion, things like that. And in the regular P&L, of course, you want to look at the revenue growth, the gross margin, any kind of fulfillment fees and expenses, marketing costs, and then traditional SG&A. I think that those are the main elements from a financial perspective. And then, of course, there are many other kind of things that people look for. They look at I think it's key to remember, Catherine, that every investor has an angle. They have a thesis. They have a way in which they approach an opportunity. And if they don't have that angle, they generally do not engage. So some have the ability to help a company go further online or to grow internationally or to come up with better product development and R&D. I think so. Again, going back to my original point, to try to cater that opportunity to each individual investor, we try to think about what angles they have or should have, and then speak to them about where we think they could excel and why that's the case.
Okay. Jay, can I bring you into the conversation? When you're doing diligence, do you have a favorite thing that you like to look at? Is there something where you're like, oh, I really enjoy this part? Or is there also, on the flip side, something where you go, good grief, do I really have to plow through this sort of data again now?
Yeah, certainly. I mean, obviously there's a diligence aspect that we do up front. I think for our business, we have a lot of disruptive businesses that are digitally native. So that's, one of the things that we enjoy doing is an expansive amount of work around companies' cohorts, we call them. And those are just performance by vintage of potential or actual purchasers. And so we have a data analytics group. They go through all the data that, a company might produce on their site, through NetSuite, on various other platforms they have, and we'll present that to a company. That's one of our, I think, something we do very well, and I enjoy doing that. I think that it's fun to kind of see those takeaways. And as we progressed as a business, we've been able to kind of iterate and learn more from those. And then as we've sort of shared those pieces of information with potential investors in our companies, we've widened, the aperture of what people look at. So that's been a positive. In terms of what's, dull, obviously, unfortunately, for a lot of the things that are on Intralinks, ultimately end up being quite dull, because what happens as you get later into a process is you have really just confirmatory oriented diligence, right? And so people are going to be spending time making sure that the insurance policies are up to date, and making sure that, all of the LLC agreements and things of that nature. So, we have to spend a lot of time collecting all that data, going through our own checklist, making sure all of that matches up, so that, any majority sale or even minority investment doesn't have any kind of footfall risk that something happens where something is, just missed. And so that's obviously a key part of what we do, but certainly not the most fun.
Okay. Let's spend some time talking about valuations. And I think lots of people, when they hear the word M&A advisor, they immediately think, well, you're the people that set the price in a transaction. But obviously while that is something that you are part of, that's not all that you do. How do you, in an M&A process, manage those expectations? And I'm here, Arash, particularly interested in sort of your experience of working with founders. And we know that this is an incredibly tricky part of the M&A sort of sphere. Those people that have put their life and soul into building a business, now it's up for sale, and in their head, they've got this one figure. And then the buyer says, well, do you know what? I don't really see that valuation there. Can you share with us some of your experiences of how to manage those those challenges?
Yeah, great question, Catherine. Thank you. So I think many founders do have opinions of their value of their company, and a lot of them talk to each other. So a lot of them feed off of each other. And in a very frothy market, there tends to be everyone is trying to one up one another. And if someone got 12 tons, they want to get 13 or 14, or they don't want to go below what that other company got. And they all know why their company is better than everyone else's. It's like your kid, right? And you never want to have the wrong opinion about your own family members. So everyone thinks everyone's great, everyone's above average. I think what we found is the founders, although they may have an opinion of value in their head, if you reason with them and you provide, credible scientific evidence as to why the valuation may come out a little bit differently, I think they usually listen to that, because at the end of the day, they're not valuation experts and they know that we are, and that's why we're in business. I think also a lot of founders, although they may have a value in their head, they're willing to take less. If they think their company's worth 500 and you dangle 435 million in front of them, usually they take that. And so although they're aiming high and that be aspirational, that's fine. But I think with some reason, some logic, some market anecdotes, they usually come back down to earth, and there's usually a happy middle ground.
I think it also is worth mentioning who the owners of the business are. We run across a variety of different businesses. Some are 100% founder owned. And in that case, the basis of those founders is frequently close to zero. I mean, maybe they've had seed capital, put their own in. And obviously they, any amount of money that they sell the business for in some ways is a win, although obviously they put all this sweat equity into it. So that's really kind of where the floor is. Then in other situations, there are meaningful venture investors in it, right? And maybe those don't necessarily have a controlling interest, but they've come in at higher valuations. And so that, and especially given that a lot of those valuations that we've seen, and I think this is broadly true, were entered into in the, in the 2020, 21, and maybe early 22 era, that sets a higher bar. And so that sort of push-pull makes it a little bit more difficult to transact in today's market, obviously, because those people don't want to take a haircut, and they're just waiting for that next iteration of growth. Or if the business is sort of stalling out, they're not ready to necessarily to jump out at that point.
Okay. Now, Arash, you said that usually with a little bit of education, using data, demonstrating sort of your expertise, you can get those founders to recognize that their valuation might be a little bit off and bring them round to the valuation that you've put on the business. But that, I'm sure, is not always the case. Or tell me if it's always the case. Are there also situations where someone has actually turned around and said, you know what, if they're not paying X, I'm walking away?
It's not always the case. Exactly right. And we've seen everything in between. So yes, we've had situations where we've gotten 15 offers for a client and they turned down all 15. And you can argue that 15 offers really speaks to where the market is, because if 15 people have an opinion of value, then it's hard to say that's not a good sample set. But we've had a couple situations where we've gotten many, many offers for clients and they said no. We've also had a situation where a client kept on asking for more and more and more from a private equity firm. And we thought for sure the PE firm was going to go away. And they actually stayed on board, and they actually gave them everything they wanted every step of the way. Now, of course, that company really wanted the client. It was a great tuck-in acquisition. They were building something larger. And so for sure, there was we underestimated how badly the PE firm wanted that, and in that situation they gave them every step of the way. We thought the deal was going to die. 5-6 times the entrepreneur stuck with his gut, and he got exactly what he wanted. The last thing I'd say is that there are other mechanisms like earnouts and other things you could build into a deal structure to bridge value, and we can go into more detail, but obviously earnouts are a key way to kind of fix that problem too.
Well, you led me very nicely there to my final question before we take a break, Arash, which was around earnouts. And I've heard it said a number of times that earnouts are often paid and rarely earned. Do you agree with that assessment? Can you share a little bit about how you have used earnouts to maybe bridge that valuation gap that you described just now?
Well, we've had a lot of success with earnouts, and the key is one, for your client to hit the numbers and also for them to be structured in the right way. I actually think it may make sense, Catherine, if I could say a separate discussion on earnouts, because we have some exhibits and some Excel models that show all the ways in which an earnout can be structured. And I think it's actually would be very illustrative for your listeners. But we've had very good experience. We've had revenue-based earnouts, EBITDA-based earnouts, everything in between. We've had situations even where clients are selling 100% of their business from a legal standpoint, but only, let's say, 70, 80% from an economic standpoint, and they're able to monetize the rest over time. So earnouts for us are something that we dig into our pocket and use very frequently and have not had many issues in their usage over time.
Super. Thank you very much. We're going to take a really quick break. And after the break, we're going to come back and take a look at how you balance the need for speed and the depth of data in an M&A transaction.
Deal Center AI. Nail every detail with the revolutionary AI-powered platform that's built for deals. Transform your deal making with Deal Center AI. Intralinks. Go forward.
Thank you for sticking with us. We're going to spend some time now looking at how the need for speed in an M&A transaction can, or what challenges it poses when we need to balance it with the need for processing more data in an M&A transaction. Over the course of this series of the Dealist, we've really heard an awful lot about how speed is increasing when you do transactions, but also how M&A transaction deal makers are having to process more and more data. Jay, can I bring you into the transaction and get you to tell me a little bit about how you guys manage those two components of an M&A deal?
Certainly. Yes, I think speed is part of it, but we actually are in an environment, I think, in today's market where speed is harder. So we're living in 2025. We have macroeconomic volatility, we have policy volatility, and I think what we've been increasingly telling our clients is that if you were to do a 6 to 9 month transaction in the past, it's looking a little bit more like 9 to 12 months, in order to actually transact. And so I think even though speed is desirable, it's a little bit more challenging. That said, we do have clients who have some overarching need for speed, whether it's a function of an existing, say, debt agreement or something along those lines that needs to be refinanced, or, their capital need is sufficient enough that they need to actually do it in relatively short order. I think it all can be managed. I do agree there's more data that, people are seeing in transactions than they were seeing, 5 years ago, 10 years ago. I think the quality, as I've mentioned, of the analytics on the part of potential investors is also increased proportionally. People are using tools to manage data rooms. They're using, so they can move quickly when they need to. But the transactional reality we live in is that speed is actually, while often desirable, just not as viable. The other thing that we see, unfortunately, for better or for worse, is that, a slower deal pace in an environment that's a little less economically kind of linear upwards is a benefit for a potential financial sponsor or buyer, right? Because they have more time to review the data that's coming in. And if something doesn't look right or that doesn't match the budget, then they can come back and push back. So if the company is doing well and it's a very straight line path up and it's a very, sort of high quality property where there's no ifs, ands, or buts about it, I think a speed to transaction is certainly possible. I think it's very possible to get the timeline of 6 to 9 months, but you have to push pace. You have to make sure all the parties are, coming out and exactly, on the timelines that you demand. And I think you have that luxury when the business is in, in great shape. It's a little more different with a business that isn't.
Arash, when we had a conversation about this earlier in the week, we spoke about the importance of knowing exactly what your clients need and having the experience to identify sort of where gaps might be. Could you elaborate a little bit on that for our listeners?
Yeah, I also think, Catherine, that exactly what the client needs varies. I think it's rare to have a situation where the client knows with pinpoint accuracy what kind of outcome they're looking for. Some generally say they want to do a minority stake, but they're open potentially to a majority or 100% sale. So I think that I think it's almost to your question. It's really thinking through what are they really solving for. Number one, are they willing to give them control or not? Number two, are they okay with a private equity partner, or do they want a strategic? Number three, you know, is there a certain level of proceeds that they're looking for, that they're solving for, to have in their bank account, pre and post tax? Where do they think they need value add? Is it helping, if they're a D2C business, do they need to go into retail channels? And do they need help with that? Do they need help with international? And I think Catherine, to your question, there is a kind of vulnerability in the client that you have to sort of bring out, and you have to really assess and have them assess where they need that help. And I think that helps us. So the more vulnerable they are, the more open they are with where they need help, the more we're able to help them and solve for that when we speak to investors.
Okay, thank you very much. I'd like to spend a few minutes talking about sort of tech tools and frameworks that you guys are using to remain competitive and agile in an increasingly demanding market with clients who are demanding more and more from their advisors. Jay, you touched on AI. Before we come to that, talk to me a little bit about what sort of the technological tools are that you're all using already, and then also how much of a role AI will play now and in the future.
Yeah, thank you, Ken. That's a great question. And, we operate as a very lean organization. As Arash said, we kind of are 10 to maybe a dozen people at any given point. And so at this moment, we try to leverage as much of the AI tool set as possible. I think, there's the obvious work that's created, through the kind of large language models like ChatGPT, where in the past, market research and deep research that was done was, something that took weeks, and you would have to send somebody, to do all kinds of, work and pull, various data sets. We have those much more easily at hand. That said, it still needs human interaction in the loop. It still needs to be deeply analyzed, and it still needs to be, reviewed for kind of its ability to actually reflect what's accurate or not accurate in the market. I think that increasingly we're seeing AI go a step further. Where we haven't really seen AI be incredibly useful is for sort of the more mundane tasks around PowerPoint and Excel. I think actually we're seeing in data rooms, I'm aware one of our partners has created a tool that allows private equity firms to download and analyze the contents of the data room or present them in simpler fashion. We still require a lot of time to cleanse those and to go through them. So, I envision over time that will improve. We actually are working with a partner that's a VC incubator to kind of help build out one of our own tools or set of tools that will help us do this in a more elaborate fashion that will hit these pain points. And, we're looking to kind of roll that out over the next, I guess, probably months to, a couple of years. So we really want to be ahead of the game, and we definitely want to ensure that we're not, that while we use people, we use them for the best ability. The way I think about AI is like, when I was starting in my career, and I'm sure the same with Arash was, we had very slow computers, and while we weren't on, slide rules or things like that, it was not as advanced as it was today, right? And so as tools have gotten more advanced and more can be done, what happens is you actually kind of enter into this arms race where the quality of what you have to produce has to increase accordingly. So, the ante becomes higher. So I really believe that AI, is not necessarily the silver bullet of solving all the problems, because, we still need to have this relationship with our clients to get this trust to solve these problems. That won't go away. But for the basic blocking and tackling, that can be done by a machine and should be done by a machine in the future. And then increasingly, we get to the point where we actually have better and better, outcomes. The last thing I'll say about AI is that it actually gives us an ability to come up with novel solutions in many ways, which I find really interesting. So, when I found that I'm in a situation, or that we're in a situation where a client has a specific niche ask. So, maybe there's a merger of a public and a private company, and they want to structure it in a certain way, and they want us to think about that. I can put that into a larger context window in AI and come up with a term sheet, and that gets me starting to think more deeply about how I would actually frame something, and gives me an advantage that I wouldn't have had. I would have had to come up with all of that from scratch, as little as 5 years ago. So it really does help our thinking in that respect.
Okay, thank you very much. I'd like to wrap up our podcast episode today by asking you both for your highs and lows in your working day. Arash, talk to me. What's the highlight of your day, and what's the point in the day where you go like, "Good grief, do I really have to deal with this?"
That's a really good question. I think the highlight is really the intellectual stimulation. I think sometimes Jay and I get together, we try to solve a difficult problem, and we just try to think through and brainstorm how to kind of maneuver the chessboard. I think for me, that's some of the greatest parts of it. There are a lot of the business, which is a little bit more mundane, coming up with the right comps, the right precedent and public comps, and running another LBO model, which can be, look like whatever you want it to look like. So I think that those are probably the highlights, the intellectual supercharged elements of the day. And then the lowlights are probably some of the more mundane Excel analyses, which we've done 1,000 times.
That sounds fair enough. Jay, I'm a bit hesitant to ask you now for your highlights and low points, because if your highlight is not intellectually sparring with Arash, that's going to be very, very sad. Tell us, what do you see as the highlight of your day?
No, I that's always a fun part of it. I think we are trying to get together every day and solve problems. And I think part of the, maybe a layer into that is that really one of the great highlights of my day is solving problems. A lot of our clients, as we've mentioned, are founders or closely held businesses that, there isn't necessarily a institution that's done this 100 times. So it's helping somebody get to an outcome that maybe they didn't expect to get. And so that's really a big highlight for me. I spent a lot of time on the buy side for the better part of my career. And, I never really shepherded companies from this, from an earlier stage into the fruition that a lot of these are experiencing. So there's a novelty element for me in that. And then in terms of the lowlights, I don't mind the modeling. I don't mind necessarily the Excel spreadsheets. I think part of being an advisor and investment banker is, we have to wear a lot of the negativity associated with folks on a particular transaction. So while we love all of our clients deeply, not every company that we interact with necessarily does as well. And so, we spend a lot of time trying to convince them that, that it's the right fit, or maybe we don't convince them it's the right fit, but trying to address issues they have. And it seems like there's in many cases, if somebody doesn't want to do a deal, they have a variety of reasons not to do it. So that can be hard at times, but I think ultimately as you get through all those, the dam breaks and ultimately somebody shows up. So that's another high point.
Jay, I loved your comment about shepherding someone through a process for whom it's a once in a lifetime sort of situation, because I think that's something that, people like you who work on so many deals, we forget that actually for some companies, M&A is something that they do once in a blue moon and they don't do it regularly. So supporting them, I can see why that would be a really, really rewarding part of your job. Gentlemen, before I let you go, there are quite a few people listening to our podcast who are in the early stages of their career in advisory. What do you think would be the best piece of advice that you could give them? Arash, maybe I can come to you first.
I would say plant a lot of seeds, meet a lot of people, network very heavily, and curry and build relationships that you think will help you down the road, because inevitably you're going to need people just like they need you.
Fantastic. Jay, your final words on that?
Yeah, I would just say, I would echo that. Absolutely stay in touch with the people, because you'll watch them all, not all, but early in your career, you'll watch many of them succeed, and staying close to them is super important as you get down the road. I'd say the second thing is, in advisory in particular, but in most jobs, you kind of goes through multiple stages. The first stage is a technical stage. So be excellent at the technical work. That's the first step. That it's required, right? And don't have anybody be surprised. Have an incredible attitude. Say yes to as much as you possibly can, even if you feel that you're overwhelmed. And then 3, ultimately realize that jobs over time become sales and relationship oriented, so that it's not really just the ability to do an incredible 3-statement model. It's the ability to actually convince people that what you're offering them is of service, of value. And so don't ever forget that part as you develop your career.
Thank you very much. That's all that we have time for in today's episode of The Dealist. I'd like to thank both Jay and Arash for sharing their wonderful insights and experiences with our listeners. If you enjoyed this episode, please like, follow, subscribe, and comment. We'd really love to hear from you. Until next time, that's all. Thank you very much and goodbye.